Okay, so in this chapter of the lessons, we're going to be looking at risk versus reward and the importance of risk versus reward. These are the bullish and bearish patterns that we do trade. These are the harmonic patterns that exist that we can find in every currency pair on basically every time frame. Whether or not there's patterns there right now, I couldn't tell you, but right now we are going to be looking at and concentrating on these patterns, these four major patterns. You can see that we have the bullish patterns, which are the bat, the gartley, the butterfly, and the crab. And below that, we have the bearish patterns, which are essentially a mirrored image of the ones above. Okay, so like a bat, just the same of a bat, applies all the same rules, it's just reversed. Okay, so these are going to be buy patterns, and these are going to be sell patterns. And so you can see that the major differences between all of these patterns are where this D point is. You can see that it's at different levels. So for instance, the bat on the buy pattern is going to be close to the X, but it won't exceed it. Okay, that's one of the rules with the bat pattern. With the gartley pattern, you can see that a gartley pattern won't exceed, let's just say, a 618 retracement, where a bat pattern would be allowed to, although the B point's going to be a little different. Okay, so we're not going to worry and go all crazy over the measurements. We'll save that for an advanced lesson if you guys want to know that. But that's going to be why these patterns are formed the way they are. And the whole thing around this and surrounding it is just that it's different fib retracements that will project our D point. Okay, so you can see here that with our bat pattern, we have a risk versus reward of, well, in this case it might be pretty good, but our bat pattern is going to have a PRZ window that's going to be fairly small. So each one of these patterns have a risk versus reward that will fit within a certain number, and that's what we're going to look at today. We're going to look at how we determine what that number is, that risk versus reward, and why it's so important with our trades. Okay, so what we're going to do is we're just going to draw on here a simple pattern. Okay, and we might start off with the butterfly pattern, let's just say. This is not going to be to scale, obviously, but it will serve our purposes for what we're trying to do. So as I said, this is our butterfly pattern, and the butterfly pattern has unique characteristics that will extend D beyond the point of X. And what we'll end up getting is, once we're up here, is a PRZ window, a potential reversal zone window of where we should enter. Okay? So it's important to look at the risk versus the reward of each pattern and each trade that we're looking at taking. So say what we're going to do here is look at the risk versus reward. Say that this box right here has a PRZ zone that from the top to the bottom is about 10 pips. Okay? What we want to do is make sure that this being our risk, if we were to enter at the point the PRZ is created, is going to at least give us a risk versus reward down here of at least, okay, at least we want to get 20 pips. Okay, so this is going to be risking 10 pips. We at least want to make 20. So our risk versus reward in this case is 1, right? 1 risk for every 2 reward. And that's important, okay? This right here is the minimum that we're accepting to trade. So if I'm going to risk, let's just say, one standard lot, which would be $10. If I'm going to risk $10 of my own money, I'm going to at least want to make 20. Or if you're doing like mini lots, if you risk at least $1, you at least want to be able to make 2. It doesn't make sense to take a risk versus reward that's inverted, where you're going to be risking $2 and only be able to make 1. I mean, if you consistently did that, chances are you're not going to be trading very long. So it's important. This is one of the rules that most new traders don't look at, is how much are they risking versus how much of the probability of succeeding do they have, and if that risk versus that reward is a good one, like let's just say this 1 to 2 is decent as a starting point of what you're willing to risk. Now this will go from 20, okay? We could also up to 60 and still say this is within our sweet spot. Okay, so based on what we've researched, that 1 to 2 to 1 to 6 are valid risk versus rewards, and you want to maintain yourself within these two patterns, or these two risk and reward ratios, in order to be successful. Okay, so anything that is greater than 6, okay, let's just say 15, the chances of your trade actually working out is going to be relatively small. And one of the major reasons why that is because if your risk versus reward is going to be 1 to 15, your PRZ window is going to be like a few pips, where in order to get that distance down to the B point. Okay, so this is all related from where you enter to your first target. You want at least a 1 to 2 risk versus reward going all the way to 1 to 6. Okay, and this is the same for when the patterns are inverted. You want to see at least 1 to 2 to 1 to 6 risk to reward. Anything greater than that, probability drops off and your chances of success are small. Okay, anything that's inverted or even like 1 to 1, there's no point of taking. I mean, there's so many of these patterns that are out there. There's no point of taking a trade that's 1 to 1. Just to risk $1 hoping you're going to gain 1 is not going to get you ahead. It's not going to get you to where you want to be and where you need to be. So you're at least looking at a 1 to 2 risk versus reward going all the way to a 1 to 6. Okay, so let's look at one more. Here we have a Gartley pattern and we have a PRZ window of 15 pips. Okay, our first target point being the B point is 32 pips below. So what's our risk versus reward? Okay, so this is going to be, how many times does 15 go into 32? And that gives us about 2.13. So every 1 pip we're going to risk, we have the potential of gaining 2.13 pips, and therefore that is a good risk to reward. If this was, let's just say it was 16 pips, and this was like a 1.06 or whatever risk versus reward, that wouldn't be something that we want to take. We're not going to, again, risk 15 pips to the point of just gaining 15 pips as well. Now, there is a little trick that you guys can do, that if you see a pattern you like and it has good structure and it has all the, let's just say, criteria that we're going to go through in all of these lessons, and you decide that this fits into your trading plan and this is something that you would like to take, what you can do is, instead of entering right at the entry, you might enter halfway through, in which instead of risking 15 pips, let's just say you're risking 8. And then all of a sudden you're risking 8 pips in order to make 32 pips. And then all of a sudden your risk versus reward becomes you're risking 1 pip, right? And for every 1 pip you risk, you're going to be gaining 4 pips, which again would then bring this to even better. One thing you should know is that as price moves into this PRZ, the further into it gets, the further risk you are taking on in the way of probability of this trade not working out. Okay, so that's something that you have to take into account. And we're going to be doing another lesson on this PRZ window and how to determine when to take your trade. So there's a few different methods that you can use there on how you can actually go ahead and take that trade. So that's a little bit on risk versus reward. We're going to quiz you on this because this is very important for you to know. This is one of the mistakes that traders make when they get into the Forex market. And one of the main reasons why they don't succeed is because their risk versus reward is inverted. I mean, they're risking, let's just say, 4 pips, and they're only shooting for 1. I mean, that's a lot. But what causes these new traders to actually fail is they're not looking at, okay, what's a good risk versus reward, a logical place to put their stop, and a place to actually enter into the market that will give them that. Okay, so that's something that we're going to be focusing a lot on as we go through these lectures, is the risk versus reward and the importance of that.